Hey everybody, Luke Gromen, FFTT. Hope you had a great weekend. I know we had a great weekend here. Weather was beautiful. Was down watching the Marietta Pioneers win the NCAA regional they were in. Translation, there's 389 Division III baseball teams in the U.S. Marietta is now in the Sweet 16. So they're moving on. This weekend they'll play in a super regional, which is super exciting. So we'll be watching that as well. So go Pioneers. So with that introduction, I also want to just briefly apologize if I sound or look a little funny or sound or look a little funnier than usual, perhaps. I got a little dental work done this afternoon. So we're going to push through. We're not going to let it hold us back. So with that said, let me jump right in. First question's from Cal. What is your best guess as to what is going on with the bond market regarding the Fed is deviating from the two-year bond, the two-year Treasury, and bond traders are pricing in cuts while the Fed repeats higher for longer? I think bond markets are looking at a capital crunch coming in the next few months where you have commercial real estate, venture capital, the U.S. government, and possibly even U.S. banks all competing for a shrinking amount of capital. And I think that has the risk, that poses the risk of sending us into another crisis pretty quickly, going from everything is awesome to holy cow pretty quickly. And so I think bond markets are looking at that, just basically the gross issuance coming in the back half of this year from all those entities. And I just don't think there's a sufficient balance sheet. And so I think that's what they are watching. What the Fed's watching, I don't know. I can make a case that there's an element of sort of currency wars going on where they're trying to continue to weaponize the dollar on some level. I really don't know what they're thinking, and so, but that's what I think. I think that's what the bond market sees, and I think the bond market's right. From Maria, can you explain in detail your tweet, quote, that the only way we do not have an oil supply crisis in coming years is if treasuries fall sharply against oil? So U.S. shale production has been 90% of global production growth over the last 10 years, according to Bloomberg citing Enverus Energy. U.S. shale production is rolling over. And so basically we need higher oil prices just to keep U.S. shale production and therefore global production probably flat or grow from here. So if oil prices don't rise sharply against treasuries, i.e. if oil prices don't rise sharply in US dollar terms, then you're gonna see a negative impact on global oil supplies as a result of US shale production rolling over faster. Basically, it needs higher prices, and i.e. a supply crisis. So there's some path fluidity to that. In other words, can you get lower oil prices for a bit? Sure, but it's not sustainable if you don't want to have a pretty severe supply crisis that should be pretty self-regulating in terms of oil prices. Just given that as you look back over the last 45 years, global oil demand fell. The two worst declines annually in global oil demand were 80 or 81, down 3%, 3.8%, something like that. And in 2020, when we basically shut down the global economy, it was down like 8% year over year. So the bottom line is oil demand, even in really, really bad economies, doesn't fall that much. So shale supply, if you stopped drilling for new, would probably fall 15, 20, 25% annually, on just a little bit of a lag. So that's what I mean, where you need oil prices to rise further to continue to incentivize growing shale production. So that's what I meant by that. From Robert, average credit scores continue to rise to the highest level in 15 years, and unemployment is down to its lowest in 15 years, all while credit card debt rises. That doesn't feel like the private sector has a debt problem. The dollar will remain the reserve currency and safe haven until significant deglobalization occurs or energy is priced in gold. This appears to be happening, however, glacially. Investors would rather stay with something like treasuries that are ingrained in the economy rather than try new things like gold or Bitcoin. Investors have been known to follow the herd off the cliff. All these things imply to me a much longer timeline before a debt spiral occurs. Can you give me your take and how you see the timeline differently? So I would say I agree, the problem's not in the private sector. Remember, we had a stock bubble in 2000. We kicked it upstairs to the banking sector when the stock bubble burst by generating a housing bubble. Housing bubble burst. We kicked it upstairs to the global sovereign debt levels by virtue of the backstops to the banking system put in place by global sovereigns. So the issue is not in the private sector. The issue is in public sector debt. In the West, this is the first time in almost 100 years that we've had a public sector, a global sovereign debt bubble, particularly, and it's centered in the West. So I would argue the debt spiral has already begun. It forced the Fed to stop hiking rates in the fourth quarter of 2018. It forced the repo rate spike in September 2019 that drove the Fed to begin regrowing their balance sheet in what they called not QE. It drove the Treasury market to crash, the off-the-run Treasury market to crash at the height of the COVID crisis in March 2020, which had never happened in my career, in Stan Druckenmiller's career, as he said a year later. That led to the Fed doing what I've termed super QE. The Treasury market dysfunction in September 2022 it led to, and that led Janet Yellen to say she was concerned about Treasury market functioning and was followed immediately by a pretty sharp episode of U.S. dollar weakness. It led to the bank crisis in March 2023 and resulted in BTFP from the Fed, which was basically a soft version of yield curve control for banks, for treasuries. So every time you hear Treasury market dysfunction out there, that what they're really saying is that's a U.S. federal debt spiral symptoms getting more acute. That's what that means. And so we are already, I think, at least 5 years into this. I would argue the kickoff was really when foreign central banks stopped growing their holdings of treasuries back in 2014 on that. And so since then, foreign central banks have sold $350 billion in treasuries. They've bought around $350 billion in gold. As long as foreign central banks are not growing their holdings of treasuries enough, and they continue to not do so for a variety of reasons, then you're going to continue to have supplies of treasuries pile up like they did in the famous episode of I Love Lucy with the chocolates, where the conveyor belt just keeps running faster and faster, and Lucy and her friend are grabbing the chocolates and they're stuffing them in their pockets, and they're stuffing them in their hats, and they're stuffing them in their mouths, and trying to figure out what to do with these treasuries. I mean, this banking crisis, this was in part because these banks got stuffed full of treasuries. They were regulated into buying treasuries over the last 8 to 9 years after central banks stopped on net. So every time Lucy's pockets and hat and mouth get too full with chocolates, you're going to have Treasury market dysfunctioning, and that's really just balance sheets, private sector balance sheets getting too full. And then you're going to have some sort of incident, repo rate spike, off-the-run crash, dysfunction in September 22, banking crisis, and then the Fed's going to have to make a decision. Do they want to stand aside and let a debt spiral really happen, or are they going to grow their balance sheet again to prevent it? And in my view, they will. They've repeatedly, not in my view, factually, they have repeatedly chosen the latter, and in my view, they will continue to choose the latter. They could always unchoose it, and that's part of the reason why I continue to maintain an elevated cash balance, is they may try to bluff the market. They may play chicken with the market and say, we're not going to step in this time. Good luck. Don't step in. See how that works out for you. In my view, in the end, they can bluff the market for a bit, but in the end, they're going to have to step in and grow the balance sheet. So that's how I see it differently. I think it's important to see the debt problem, the debt bubble, the bubble and everything. It's not in private sector assets. The bubble is in Western sovereign debt, and in particular, the risk-free asset underpinning all the other assets has risk, either nominal or credit risk, and that's the first time in anybody's career, anyone trading today has ever seen that. So that's how I see it differently. From David, any updates on the daisy chain QE thesis? Is it still a possibility? Yes, it's a possibility. I saw in March UK holdings of treasuries up $70 billion. March versus February, up not that much year over year. So you are seeing some buying. Canada bought a little bit as well, March over February. So maybe. But not a big increase, so it's inconclusive. Let's wait and see. But I'm still watching to see if we get more follow through on that. From John, to what extent do global holders of dollar debt also hold dollar bond and stock assets? I'm wondering what effect of a slowdown in global commerce would have based on dollar debt holders who may need to look to other sources of dollars. It's a great question. It's a really important question. This is why I always cite and make a big deal about the U.S. net international investment position at negative 70% of GDP. That is far more negative than it's ever been before. Even in 2008, that number was negative 8 to 10% of GDP. In 2001, that number was negative 1 to 3% of GDP. And prior to that, it was positive. What that means is at negative 70% of GDP, foreigners own $18 trillion net more dollar assets than we own of their assets. So bottom line, they're net long dollars. They're just not in dollar format. And to your point, it amounts to basically foreigners having an $18 trillion piggy bank of dollars that they can break and grab the money out of when they need it. What does break and grab the money out of look like? Dump treasuries to get dollars like they did last year. Dump stocks to get dollars like they did last year. And this is why too strong a dollar has consistently driven aggressive dollar asset sales going back at least 5-6 years. So it's a great question. Yes, they can. They own assets and they can sell them to get dollars if need be. From Andrew, with respect to the issues faced by commercial real estate you discussed in this week's Tree Rings, do you have an opinion on how single-family home values will fare over the next couple years? I don't have a strong view. I think some of it, of course, as always with real estate, depends on location. If you force me to take a view, I would probably say overall as an asset class, I think it'll continue to kind of be like what we've seen over the last 12 to 18 months, which are brief periods of weakness, but overall between being a hard asset and the reality that the U.S. government needs sustained high inflation and negative real interest rates to continue to sustain the debt levels that they have, I think it will probably continue to fare just fine as an asset class. I don't see anything like a 2008 kind of scenario again where you get this just unmitigated housing crash. Because again, the problem is at the public level. An unmitigated housing crash basically implies the Fed is willing to stand aside and let the Treasury market go. And I don't think they're going to let that happen for very long, if at all. From George, is there a reasonably likely pathway for Yellen to top up the TGA without affecting or even increasing liquidity? In my opinion, it's unlikely that she could top up the TGA without negatively impacting dollar liquidity. Maybe, and this is just me sort of trying to spitball for some ideas, maybe she could use the Exchange Stabilization Fund, which again is a pretty big fund that has very little oversight. She and the president can use as they see fit to impact currency markets, exchange rates, gold markets, etc. Maybe she could use the ESF to weaken the dollar while topping up the TGA. So withdrawing dollar liquidity with the TGA while manipulating currency markets with the ESF, for lack of a better word. I don't know how easy that would be to do. Currency markets are very big. ESF is big, but not enormous, not infinite. But it would be theoretically possible, at least. And again, I'm just spitballing, trying to think out loud for how she could do it. So you'd be adding dollar liquidity by weakening the dollar, reducing dollar liquidity by topping up the TGA. But beyond that, I don't really know how she could do that, other than by maybe really ramping up spending, just fiscal spending. So that's those are my thoughts there. And then the final question from Simon. You've highlighted, how federal spending drives GDP, which drives tax receipts. How does the potential for a lower rate of spending growth out of the debt ceiling deal influence your outlook? If they actually lowered spending or lowered spending growth, both of which I'm skeptical on to varying degrees, then all else equal, that would probably drive what we saw last year in 2Q and 3Q, when you actually did have a decline in federal spending that was pretty notable for a brief moment in time in the grand scheme of things, which is spending down, dollar is measured by DXY up, inflation down sequentially, GDP growth down sequentially and actually nominally for a quarter or two. And that would be followed pretty shortly thereafter by increasing Treasury market dysfunction, and then ultimately receipts, assets down, asset prices down, and then not too far after that, tax receipts down. So, and then you'd probably get into banking strains again, like we saw earlier this year, and then we'd get into Fed liquidity injections of some description, like we saw this year. So, great question, but that's how I would think about it if they really ratcheted back on the spending. That's sort of I think the flow chart of my view of how it would work. So with that, I'm going to finish up for tonight. Thank you as always for joining me. And if you're interested in these types of updates, check out FFTT tree rings. You can learn more information about that at FFTT-LLC.com, as well as what we're up to, etc. And in the meantime, thanks again for joining me. I look forward to talking with you soon, and go Marietta Pioneers. Take care, everybody.